Okay, real talk. The stock market crashes about once a decade, and every time we swear we finally fixed it, then it happens again. So let's just run through all of them, fast, 1907 to now. It counts if the market fell around 20% or worse. And watch for the one thing that never changes. 1907, the one with no fire department. Start with 1907. The market's climbing, everyone's getting rich, life is good. Then two guys try to corner the copper market, basically buy up enough to control the price. It fails. The bank funding them collapses, and other banks start going down like dominoes. Now, here's the part I love. There's nobody to call. No central bank, no government backstop, no insurance on your deposits, nothing. So the whole rescue comes down to one rich guy. JP Morgan literally locks the top bankers in his personal library. Nobody leaves until they pool their money and stop the bleeding. And it works. The panic ends in weeks with the market down about half. Afterward, Congress looks at this and thinks maybe the whole country shouldn't depend on one man with a big library. 6 years later, they build the Federal Reserve. So the Fed you hear about on the news, it exists because of this. Hang on to that, it comes back. 1929, the one your grandparents warned you about. The 1920s were one long winning streak. And the thing about us is, when winning starts to feel guaranteed, we start betting with money we don't actually have. Back then, they called it buying on margin. Don't let the word scare you, it just means buying stock with borrowed money, not profit margin, borrowed money. And the logic felt airtight. Stocks always go up, so borrow, buy more, pay the loan back from the gains, free extra winnings. Then, October 1929, the market takes it all back, with interest. And not in a day. It slides for almost 3 straight years, until 89% of it is gone. Then the number almost nobody tells you about how long to get it back. The market doesn't return to its 1929 high until 1954. 25 years. A baby born the week of that crash was married with kids before it broke even. So this time, we write a real rule book, a new agency to police the market. Insurance on your bank deposits. Banks legally split in half. Surely that does it. This time is different. 1937, the one we did to ourselves. Nobody attacked this time. We did this one to ourselves. The economy was still crawling out of the Great Depression when the government decided it looked healthy enough and pulled back. Raised interest rates, cut spending way too early, and stocks lost about half their value in roughly a year. No new law came out of this one. Just a warning central bankers still whisper to each other today. Don't rip the IV out before the patient's actually healed. Honestly, sometimes the economy doesn't need an enemy. It just needs one of us to get impatient. 1962, the one about nothing. This one crashes over basically nothing, and I mean that. Stocks had run up hard. President Kennedy picked a very public fight with the steel industry over prices. Investors got spooked and down more than 20% in 6 months. Back to the highs in about a year. Nothing actually broke. The market just got too excited and tipped over on its own nerves. And look, that should worry you more, not less. Because if it can fall apart over nothing, imagine what it does when there's a real reason. Which, spoiler, is exactly what's coming. 1973, the one that came from outside. October 1973. And this one doesn't come from Wall Street at all. OPEC, the big oil-producing countries, cuts off oil to America over a war in the Middle East. Suddenly, gas lines wrap around the block. And the economy does the one thing it's not supposed to be able to do. Prices go up while everything shrinks at the same time. We literally had to invent a word for it, stagflation, because the textbook said it couldn't happen, and it broke every tool we had. Fight the rising prices, you deepen the recession. Fight the recession, you feed the prices. Pick your poison. Stocks got cut nearly in half, and once you adjust for how little those dollars were worth by then, the real recovery dragged on into the early 90s. 1987. The day the machines panicked, 22.6% in one single day. Still the worst day the market has ever had. And the day before? Totally normal. The culprit was Wall Street's shiny new idea. Portfolio insurance. Sounds protective, right? It was really just an automatic sell button. When prices drop, your computer sells for you to cut your losses. Which is fine until everyone's holding the same button. Prices dip, the computers sell. That pushes prices lower, so they sell harder. We basically built machines to panic faster than we ever could ourselves. So we add circuit breakers, automatic timeouts that halt trading when the market falls too fast, a forced breather before the computers finish the job. 1990 and 1998. Blink and you miss them. Two quick ones because they count and almost everyone forgets them. 1990. Iraq invades Kuwait. Oil roughly doubles. The market drops about 20%, shrugs, and moves on. 1998. A hedge fund with a very confident name, long-term capital management, makes gigantic bets with borrowed money and nearly drags the whole system down with it. The Fed has to quietly arrange a private rescue. Borrowed money again? And I promise, you're going to keep seeing it. 2000, the one where a single word cost $5 trillion. The internet is brand new, and we all decide that any company with a website is a guaranteed fortune. No revenue, no profit, sometimes no actual product, priced like Ferraris with no engine. We weren't really buying companies. We were buying the word internet. Then reality shows up. The tech-heavy index loses 78% of its value, and it needs 15 years just to see that high again. Our fix this time: tougher accounting rules written while a giant called Enron was busy imploding right next door. 2008, the one that comes for your house. Okay? Lean in for this one. It built the exact world you're investing in right now. Banks were handing mortgages to people who clearly couldn't repay them. The polite term is subprime, meaning high-risk borrowers. Then they bundled those shaky loans together, sold the bundles all over the world, and the rating agencies stamped them top-grade safe. They were not safe. And here's the trap. Everyone in that chain got paid to keep it going. Nobody got paid to stop. And honestly, put you or me in one of those seats, salary on the line, we'd probably have kept going too. That's the scary part. It wasn't villains, it was incentives. Housing falls, the whole chain unravels, Lehman Brothers collapses, and global lending just freezes. The market loses more than half its value. It bottoms out at 666. Sometimes the universe really doesn't try to be subtle. Our rescue this time is the biggest ever attempted. New banking rules. And then the move that changes everything. The Fed cuts interest rates to basically zero and starts printing money to buy up debt. Remember that move? It's about to matter twice. 2020. The fastest wipe ever. A pandemic tells the entire economy to stop. So it stops. The market falls 34% in about a month. The fastest crash of this size in history. But this time, the rescue lands in days, not years. Rates back to zero, trillions of dollars from Congress, and a brand new all-time high in about 6 months. Now put the two recoveries side by side with me. 1929, 25 years. This one, a single summer. And that's the part that actually matters for you. The size of the drop is just a scary number on a screen. The recovery time is your real life. It decides whether your retirement account bounces back when you do, or 20 years too late. We learned how to shrink that timer, and the bill for that trick, it shows up next. 2022, when our own fix became the problem. For over a decade, money had been almost free, near zero rates ever since 2008 and 2020. Every price on every asset was quietly built on top of free. Then free ended. All that money sloshing around finally caught up. Prices jumped and inflation hit about 9%. So the Fed raised rates faster than it had in 40 years, and the market dropped around 25%. And notice this crash wasn't caused by copper or computers or a virus. It was caused by our own rescue from the last crash. The cure from 2008 grew up and became the disease. The trigger is different every single round, but the setup underneath always identical. An economist named Hyman Minsky boiled it down to one line. Stability itself is destabilizing, so the calm isn't the break between crashes, the calm is the crash still being built. So take one thing from me today, friend to friend, it's never the crash that gets us. It's how safe we let ourselves feel right before it.